I did my best to tell you guys these bubbles were gonna pop. And unfortunately, I only have about 3,000 subscribers. But the ones that have been listening have found tremendous value for sure on the free watch list and updates that I give on individual stocks. If you're new to the channel, welcome in. My name is Cole, and the whole point of this channel is to simplify investing and create a free community and give unbiased information the best way that we possibly can. Two stocks I really want to hone in on is going to be Palantir and Tsla. These stocks have exploded individuals' channels that have pumped up both of these companies and unfortunately have brought a lot of people along for a heck of a ride.
Apparently, there's a Seeking Alpha article that just came out claiming Palantir should be valued at $5 per share. So let's do this in a constructive manner. Now, this is not personal. I don't know the guy. I couldn't care less. But let's do it in a scientific manner. So my hope is that this was helpful for you to understand about Palantir, about their business, about how a $5 valuation makes absolutely no sense. I value the company anywhere from $25 to $35, even more on the high side. I think they'll get there, but I think at this point, it just becomes a test.
Now, as we can see here, Palantir is closer to $5. And Tom Nash absolutely dogged an article on Seeking Alpha that said that Palantir is probably worth about $5 when the stock was trading between $30 to $35. And once again, he pumps up Tsla.
Same trajectory as I, and do your own research and find out. Now, there will be a whole DCF, which I did on Tsla, to reach to my $2,500 price. It will be available to download on our Patreon page. If you want to join, it's $5 per month. You can get the DCF, but you can also stay if you want.
Now, personally, guys, I don't know what kind of analysis that Tom Nash is doing, as I was getting about a $7 to $8 price target when Palantir was around $30 to $35, as I found it an interesting company, couldn't justify the price that it was given. And once again, for Tsla, guys, I wasn't getting the $2,500 price target that Tom Nash got. Now, I'm not saying I'm smarter than Tom Nash. I'm just saying that I'm kind of questioning where he's getting these price targets. And it seems that people that cheerlead these stocks actually get more subscribers and more views. And unfortunately, the people that don't, like myself, get dislikes on their videos even though they are extremely accurate. Now, if you have a few minutes, let me explain about a few things that have happened throughout the last couple years. We've seen this number before, but not to the extent that we've seen it today. If we go back to the dot-com bubble, we can see that in 2000, 397 companies went public, and in 2001, 141 companies went public. Now, what happened? We obviously had a pandemic, and we got flushed with stimulus, went back to work, our accounts were as healthy as they have ever been, and people got interested in investing. Same thing has happened in the dot-com bubble when a lot of innovation took place, and basically anybody that had a .com behind their name became investable. Fast forward to 2021 when we had 1,035 companies go public. Never in the history of the stock market have we seen as many companies go public and receive as much capital as they ever wanted. If anybody had a new SPAC idea, it got $1 billion valuation right off the rip. And what happened? YouTubers preyed on this and created content around these companies that were questionable as far as fundamentally sound and definitely questionable for some of the business models. So we're essentially living a dot-com bubble once again. Let's think about this. Out of 1,035 companies that went public, how many are really legitimate? Well, over the last couple years, only 22% of companies actually have true fundamentals and free cash flow, which means that there's probably a few thousand companies over the last couple years that are going to go under here in the near future. Now, I don't know if those are any of your companies, but when we think about the bottom of the pandemic and what has caused the market to hit a recent top, it was pretty clear to see that it was stimulus, euphoria, and easy monetary policy. We had interest rates at near zero for the last 10 years, causing a massive bull market and financial dysfunction. So what are we starting to notice? We're starting to notice that people don't really truly understand fundamentals. Now that we're going back to a normalized interest rate, an interest rate where we have to go back to 2007 and 2008 to get to where we are today, it is a different stock market. And we've been warning of this stock market for 14 months. I told people that there is a high probability of us heading into a recession. And the things that cause this market to explode up are going to be the things that deflate this market, but also pop some of these bubbles. And we're starting to see those bubbles being popped. So if we know why the market went up and we're understanding why the market went down, then there's a couple other things I want you guys to understand. I tend to believe that a lot of indexes are in bubble territory, where the top 5 or 6 holdings are carrying the total weight of this index, meaning that you're probably not getting enough exposure to some of these contrarian undervalued plays that you definitely want to own. And this is something we've talked a lot about on the channel. What has happened over the last 10 years is there's been more indexes created, more ETFs, and more passive income investing taking place, which is great overall. But the problem becomes when you don't rebalance these portfolios and most of the money is going to the top 5 or 6 holdings, you're not really as diversified as you think. Therefore, I do believe that there is a bubble formulating within passive investing. When we pull back the S&P 500 once again, we see that the market is down roughly 20% year to date, but energy is nearly up 60%. So right then and there, we already see that even though the market's down 20, there's a sector within the market that's up 60. Now, this is just a brief example of a point I'm trying to make. With that being said, there's been massive flocks to safety in individual stocks that are getting expensive as well. And I'm talking about companies like Coca-Cola, McDonald's, and a few others that pay dividends but have brand recognition and pricing power. These are starting to get in bubble territories as well, which is limiting the areas to hide and possibly invest. And therefore, I tend to believe that there's competition now for stocks in a 2-year treasury, and there's definitely competition in cash right now as the market is very vulnerable, in my opinion. And I tend to believe that retail investors are getting pretty sick of garbage stocks being pumped, and they are definitely throwing in the towel as well. So on this channel, I've created a free watch list. We try to go live and talk about contrarian undervalued type plays where we could preserve capital and possibly outperform the market. None of this is financial advice, but I take you through what I'm personally seeing and we discuss it as a group. No Patreon needed, no membership needed, that any investment can go sideways. When we think about the top holdings in history, AT&T and General Electric were some of the most popular stocks in the world and made up most people's retirement plans. Fast forward to today, and those are 2 companies you probably don't even want to own. So it's very important to understand, does somebody have your best interest? Or are you just doing what everybody else is doing? As always, guys, appreciate your time and thank you so much for spending it with me. We will see you in the next one. Peace.